Imagine borrowing rupees 5 lakh through a personal loan. The approval takes minutes. The money arrives almost instantly. No years of saving, no difficult conversations. No waiting. Just a few clicks and the cash is in your account. It feels like a solution, and in many cases it is, until the EMIs begin, month after month, year after year. And then one day, somewhere in the middle of the repayment journey, you check your loan statement. You've already paid lakhs. Yet the outstanding balance seems stubbornly high. That's when many borrowers discover an uncomfortable truth. The real cost of a personal loan isn't the amount you borrowed, it's the time you remain in debt. Because the longer the loan survives, the more opportunities interest has to take a bite out of your money. And that is exactly why understanding how to pay off any loan years early can be worth far more than most people realize. Not because it feels good, because the math is ruthless. Let's start with a simple story. Two friends each take a rupees 5 lakh personal loan. Same interest rate, same tenure, same EMI. 5 years later, one has finished the loan much earlier and paid significantly less interest. The other is still making payments. What changed? Not luck, not income, not intelligence, just strategy. Because personal loans are different from many other forms of debt, they often carry higher interest rates, sometimes much higher. While a home loan may charge single-digit interest rates, personal loans can easily reach double digits. That difference sounds small. It isn't. A few extra percentage points can translate into tens of thousands of rupees over the life of the loan. And that's where the hidden game begins. Most borrowers focus on the EMI. Banks focus on the tenure, because tenure determines how long interest gets to work. Imagine interest as a taxi meter. The longer the ride continues, the higher the fare climbs. Personal loans work in a surprisingly similar way. The debt doesn't become expensive overnight. It becomes expensive gradually, quietly, month after month. Which is why shortening the journey can dramatically reduce the total cost. Now here's something many borrowers never realize. During the early months of a loan, a large portion of your EMI goes toward interest. Not principal. Not the actual amount borrowed. Interest. This means your balance often falls slower than expected. You're moving forward, but not nearly as fast as you think. And that's where the first strategy appears. Extra principal payments. Simple, boring, extremely powerful. Imagine making one extra EMI every year. Just one, not every month, not every week, one additional payment annually. That extra payment goes largely toward reducing principal. And principal is the source of future interest. Smaller principal means less interest. Less interest means faster repayment. Faster repayment means fewer years trapped in the loan. It's a chain reaction. One extra payment creates benefits long after the payment itself is forgotten. The irony is that most people underestimate these small actions because the results aren't immediate. Humans love visible progress. We enjoy dramatic transformations. But debt reduction rarely looks dramatic. It looks like spreadsheets, statements, and quiet math. Yet quiet math can save enormous amounts of money. Then comes the second strategy. Target the loan whenever unexpected money arrives. Bonuses, tax refunds, incentives, side income, cash gifts. Most people immediately think about spending opportunities. A vacation, a gadget, a car upgrade. The brain is remarkably creative when money appears unexpectedly. But every lump sum payment directed toward the loan attacks the principal directly. And every attack on principal weakens future interest. Think of it like removing fuel from a fire. The smaller the fuel source becomes, the weaker the fire burns. The same principle applies to debt. Now let's talk about something banks rarely advertise. Lower EMI isn't always better. That sounds strange because lower EMIs feel comfortable, affordable, safe, and they are, at least in the short term. But lower EMIs often come with longer repayment periods. And longer repayment periods mean more interest, sometimes substantially more. Imagine being offered two options: a slightly higher EMI for a shorter period, or a lower EMI stretched across several extra years. Most borrowers instinctively choose comfort. The smaller monthly payment feels attractive. But the total cost often tells a different story. It's one of the most successful psychological tricks in lending. People focus on the monthly burden. The lender focuses on the total repayment. Both are looking at the same loan, yet seeing completely different things. Then there's another hidden opportunity: increasing your EMI after a salary hike. Most people experience income growth over time, not always dramatically, but gradually. A raise here, a promotion there, a better job somewhere along the way. The common response is lifestyle inflation. The bigger phone, the nicer vacation, the upgraded car. Suddenly the additional income disappears, almost magically. But imagine redirecting just part of every future raise toward the loan. Not all of it, just a portion. The loan balance doesn't care where the money comes from. It only knows it's shrinking faster, and shrinking balances reduce interest automatically. This is where debt repayment starts becoming a strategic game rather than a monthly obligation. Now here's the uncomfortable part. Many people spend years searching for investment opportunities while carrying high-interest personal loans. The logic sounds reasonable. Why not invest and grow wealth? Sometimes that works. But often the guaranteed return from eliminating a high-interest loan is difficult to beat. If a loan costs 15% annually, every rupee used to reduce that debt is effectively avoiding future interest charges. That's a powerful advantage. Not glamorous. Not exciting, but powerful. Because personal finance isn't always about chasing the highest return. Sometimes it's about stopping the biggest leak. And high-interest debt is often a very expensive leak. The broader lesson here goes beyond personal loans. Modern economies are built on borrowing. Credit cards, car loans, education loans, personal loans. Debt is everywhere. And debt itself isn't the enemy. Debt can create opportunities, solve emergencies, bridge financial gaps. The real danger is allowing debt to linger longer than necessary. Because interest is patient. It doesn't demand attention. It simply waits. Month after month, year after year, collecting its share. Quietly, relentlessly, until borrowers wonder where all their money went. Which brings us back to the central question. If paying off a personal loan years early is mathematically possible through relatively simple strategies, why don't more people do it? Partly because life gets busy, partly because financial education is often missing, and partly because the benefits of debt reduction are invisible until years later. Nobody celebrates avoided interest. Nobody posts screenshots of future savings. But those invisible victories can transform financial outcomes. The truth is that most personal loans don't become expensive because of the amount borrowed. They become expensive because of time. And time is one variable borrowers often have more control over than they realize. Every extra payment, every prepayment, every increase in EMI, every reduction in principal. They're all small decisions that shape the future cost of debt. And when combined over months and years, those decisions can mean the difference between carrying a loan for its full term or escaping it far earlier than expected. The question is whether most borrowers will discover that before interest collects another year of rent on their money. Like, share, and subscribe for more interesting videos. And comment below. If you received an unexpected rupees 1 lakh tomorrow, would you invest it or use it to pay off your loan faster?